Let's take a look at Chapter 12. Chapter 12 is about estimating cash flow and estimating risk. So in previous chapters, we've talked about capital budgeting in Chapter 11, and they just gave us the numbers for cash flows in that chapter. They said the project cost will be an initial large negative outflow, then future positive cash flows typically. And they just gave us the cash flow. So this chapter is really about how do you go about calculating what the cash flows are for projects. So it's about cash flows and risk. And here's the big topics we'll take a look at right here. And so they're giving us right away an example to take a look at. And I just want to remind you that the way the book is organized, they give us an example in the PowerPoint slides. And they also give you usually a little bit more detailed and in-depth example throughout your chapter also. So always take a look at your chapter, the example there, take a look at the example here in the PowerPoint obviously, but between the two that should give you a pretty good flavor for how you go about doing these. So the project we're looking at is to buy some equipment. It has an initial price of $280,000, and then we're going to depreciate that away, and the after-tax cost is 280 times 1 minus t, which is 210. So we're going to take some bonus depreciation with the new tax law that we're allowed to do. And so that's part of the initial cost is the cost, but we get some depreciation advantages because that reduces our tax bill. And then for inventory, because we're buying new equipment that we're going to make a new product, we need to buy inventory. We're going to finance that inventory partially by taking on more accounts payable, and then we'll sell the new product, 100,000 units, at a price of $2 per unit, and the variable cost is 60% of sales. So basically our cost of goods sold essentially would be 60% of the sales price. So we're going to sell something for $2, 60% times $2 is $1.20, and that's my equivalent of cost of goods sold or variable cost. So we expect the project to last for 4 years. We talked about the depreciation. We're interested in cash flows, so our focus is on tax depreciation, and equipment will be fully depreciated by the time of purchase. So the salvage value would be $25,000, the tax rate's 25, and the weighted average cost of capital will be 10. So that's all important information needed to do the calculations. So remember that when it comes to cash flows, we care about what they call a relevant cash flow. And relevant means what will the new cash flows be with the new project that would be different than if I did not take on the project, right? So anything that's relevant is something that's new because of the project being undertaken. And so we need to identify the various changes in the net working capital also. So the initial costs becomes right here. Our free cash flow for year 0, which obviously would be a negative. That's going to be a cash outflow. And then in the going forward, years 1, 2, 3, and 4, we're calculating the operating cash flows. So the operating cash flows include the fact that we're going to manufacture the product and sell it. Obviously, whenever you have a revenue, you have those variable expenses. We also have to go out and buy new inventory and partially finance that, so that increases our net operating working capital. And so that's what happens in year 1, and year 2, and year 3. In year 4, we finish the project. We manufacture the last batch of products. We terminate the project because this project has a 4-year life, and so that means the machinery would be maybe not usable anymore. It'd be worn out. We have to kind of make a new decision. Do we buy new machinery to make this product, or do we do something different? But the project has a 4-year life, and so we have the last year of operating cash flow plus the terminal cash flows, which should be some recovery of the net operating working capital as our inventory balance kind of dwindles down. We use it all up, and then as we salvage the old equipment, sell it for what we can, and receive some cash flow from that also. So the next slide kind of explains how net operating working capital changes because of this. So it says we're going to, in year 1, increase inventory by $25,000, buying the raw materials needed to manufacture the product. We're also going to increase accounts payable by $5,000, which is common. Obviously, as inventory goes up, your payables go up. And so the net operating working capital is the change between the two, 25 minus 5 for 20. So, and then the initial year outlay for the capital expenditure is 1 minus T. So it's that 250 times 1 minus T, T being 0.25. So 250 times 0.75 is 210. And so we get that bonus depreciation in year one. And that's something new with the new tax law, that you can depreciate something up to a certain amount, all of it in year one, as opposed to stretching that out over a few years. So the free cash flow in year 0 is a negative 230. And then this shows us what our cash flows would be after we manufacture the products. Remember, we're making 100,000 units. We sell them for $2 each. So this is in thousands. So our revenue is $200,000. Our operating costs then are 60% of that for 120. And then that gives us our EBIT. So there's no depreciation because we did the bonus depreciation at time 0. And so there's nothing to worry about in years 1, 2, 3, and 4. Then we do the EBIT. We then tax affect that. We pay 20%, 25% tax on that. And so my EBIT after tax is 60. I don't worry about adding back depreciation because I took it all in year 0. So my cash flows for years 1, 2, 3, and 4 are 60. That's my operating cash flow. But I also have a terminal cash flow at the very end. So at the very end, my equipment's been fully depreciated, but it still has a salvage value of $25,000 that I expect to be able to sell it for. So it still has some value to somebody as scrap metal or for the parts or whatever it would be for, that somebody, in my estimation, would pay me $25,000 for that. Well, remember that this has been fully depreciated, so that $25,000 is a capital gain. And so I have to pay tax on that at 25%. So the after-tax value is 18.75. Also, I use up that final batch of inventory, and so my inventory balance goes down, my accounts payable is paid off, and I recover that initial cash outflow back in year 1 for net operating working capital. I now get that back, and so my terminal cash flow is 38.75. So I have to put that in that final year and include that. So that kind of just answers some questions here about terminal cash flows. Net operating working capital is recovered at the end of a project's life. It's just simply using up inventory, paying off the final accounts payable, and that will then recoup the initial cash outflow of net operating working capital. There's no tax impact on that. Is there always a tax on salvage value? The answer is maybe. It depends. And we simply take salvage value minus book value, and that would be your capital gain, or potentially even a capital loss, and you multiply that by T, being the tax, of course. In this example, salvage value was 25, book value was 0, because we fully depreciated the equipment on the day we bought it. We were able to with the new tax law. And then it says, is this tax on salvage value ever a positive cash flow? Yes. So if we sell equipment at a loss, if I take a capital loss by selling something, in other words, salvage value is lower than book value, then I get a tax credit for that. I get a tax benefit. So that would be a positive cash flow. It just depends. When I sell this, is salvage value larger than book value or smaller than book value? That determines if it's a positive cash flow or a negative cash flow. Okay. So, should financing effect be included in cash flows? No. So we kind of talk about this in the WACC chapter. Once we calculate the WACC, that does take into account financing. So the WACC already includes the cost of financing, the weighted average cost of financing, right? And remember that corporations finance their projects many ways. Obviously debt, that could be bank debt, corporate bonds, and then equity. And equity is made up of preferred stock, common stock, and your own retained earnings. So it's all those, each has a different cost. Each one obviously has a different weighting. and that's how you come up with whatever the WACC is. And that's a calculation that should be done frequently, at a minimum once per year. A company should be computing what its WACC is. Remember that the WACC is kind of forward focused. So, once per year, you should at least be kind of recalibrating what that WACC should be. But I do not take into account the true financing costs. Like if I went out and took out a loan to buy this $250,000 worth of equipment, I don't include that specific interest cost. As long as I apply the WACC, I'm good. I've got everything taken care of. Okay. Otherwise, if I also add interest expense or dividends or something to this, I'm double counting, which means fewer projects would pass the calculations and pass the test. Then another question is, should a $50,000 improvement cost from our previous year be included in the analysis? And the answer would be no. That's a sunk cost. And a sunk cost is something that's happened in the past that cannot be changed. Okay, so let's just say, this says improvement cost. So we looked at a building that's empty, and we commissioned a study to figure out what we should do with the building. We spent $50,000 to try to figure this out, and maybe that included maybe some kind of a market analysis or market study that helped us figure out, should we sell it, should we lease it, should we improve it, should we buy equipment and launch a new product, which obviously is the route that we took. So we spent $50,000 to help us make a decision, right? And it's not a bad idea. Obviously, it's a lot of money, but if we're going to potentially spend, hundreds of thousands or maybe even millions of dollars on whatever that study says, we want to make sure we're making the right decision. So we spent $50,000 to help us make a good decision, right? Sunk cost happened in the past. It has no impact on the incremental. And so whenever we look at cash flows, we use the word incremental. That means change. So if I launch this new product line and buy this equipment, all I really care is, what are my new cash flows based, that are different from doing nothing. Okay. So maybe we get that study back and it's just inconclusive about what to do, right? And we're not sure what should we do. And maybe we take a few years to figure it out. We wait for market conditions to change before we do something with it. So it's happened in the past. It's a sunk cost. And the book talks quite a bit about sunk costs. So make sure you look at that also. So here's another variable. So now it says, well, we could just rent out this building for $25,000 a year. Okay, so instead of buying equipment and filling it up and making a product and selling it, we could just take the easy route and sign a lease, lease it to somebody for $25,000 a year. Which, assuming that the company we lease it to or the person we lease it to has adequate cash flow, we can pretty much just bank on this, right? And we can do the credit checks and all that kind of stuff to kind of verify the ability of the person leasing it from us to pay us back. But if we're reasonably certain that we'll get paid back, I'm good, right? So if I rent it out for $25,000 and then my tax rate's 25%, my net after-tax cash flow is $18,750. So the question is, should this affect the analysis? And the answer is yes, because this is opportunity cost, right? So I've got an empty building. And right now, maybe I just boil it down to two decisions. Decision one is I buy equipment, make a product, sell it, and then I get cash flows from that. That's option one. Option two is I lease it to somebody and I'm guaranteed I'm locked in at a net cash flow of $18,750, right? And so if I choose one, I give up the other. And so in accounting, there is no journal entry to debit opportunity cost. Okay, it does not exist. So from accounting classes, you might be thinking, well, I would never include this. But in finance, we're trying to figure out what's the true cost of something. And the true cost is not only what I spend to launch a product, but what I gave up in order to launch that product. And so I've given up a net $18,750 in order to buy equipment and launch this product line. So in reality, I should charge this against my product and just say that's $18,750 of cash flow that I've given up and reduce my project cash flows by $18,750 per year. That's how I would do it. That's how I would take care of that. Now the other point here is, what if this new product line that we're launching would affect other product lines? And we don't know. They're not really telling us one way or the other. But if it does, either good or bad, that would be an externality. Okay. And a good example of an externality is store locations, is how many stores do you have in a particular city. Like I like to use Home Depot as an example because the book has used Home Depot. And let's just say, in Sioux Falls we have one Home Depot, kind of more on the west side, off of 41st and Louise in that neighborhood. Okay, so one Home Depot store. It's probably safe to assume that if Home Depot corporate decides Sioux Falls is big enough for a new location, and let's just say they build over on the east side of Sioux Falls, where now you're closer to Brandon and southwest Minnesota, northwest Iowa, it's probably safe to say that people on the east side and that are closer to that area would travel to that store and not go all the way to 41st and Louise and go to the existing store, right? So it's probably safe to say if Home Depot builds another store, that they should expect sales at the existing store to either go down or not increase at the same rate that they previously have been increasing, right? There should be a negative impact on that store. Now, not forever, right? As Sioux Falls grows, as the city gets bigger, sales will rebound. And the goal is that with two stores, you have more sales than just one store, right? So Home Depot corporate have to go through that calculation, what the cost of opening a store is, and make that decision of, does it make sense to have two locations, right? So anytime you see a business opening a new location in a particular city, just know there's a good chance they're taking sales away from an old one. And typically won't add a second location unless they feel like there is the demand to support more than one location, obviously. So that's an example of a negative externality. A positive externality would be something like iTunes and the iPod. When iPods first came out many years ago, it would have been useless without iTunes, right? If Apple says, here's this device that will hold thousands of songs digitally, you're like, awesome, how do I put songs on there? Well, we haven't figured that out yet. You wouldn't buy one, right? So it does not make any sense to buy an iPod without the ability to download the song of your choice, music of your choice, onto that device using iTunes or whatever service you use. Okay, so that's a positive externality, a complement. So they can be complements or substitutes. We have to keep that in mind. We don't know. They haven't really told us with this project what the situation is. But I need to take those into account. If I believe I've got either a positive or a negative externality, I do need to take that into account with my calculation. So this is going back to the base case scenario and just saying, okay, in the initial year, the cash outflow will be $230. Then we'll have 3 years, years 1, 2, and 3 of 60. In year 4, we'll have a positive 98.75. So we run this through our calculation. We go ahead and run this through all the NPV, IRR, MIRR, and payback, and then make a decision, right? And remember, the cost of capital was 10%. And so I'm not going to run you through those calculations because we've already done that in Chapter 11. So you guys know how to do that. But you can see here, remember the decision rules, right? NPV is negative. Not a good sign. I need that to be positive if I'm going to say yes. Both IRR and MIRR are below 10, meaning I did not jump over the hurdle rate being 10. And the payback is 3.5. Well, it's good to know, but that doesn't necessarily help me make the decision. You can kind of look at payback from this perspective. It's a 4-year project, and it takes me 3.5 years to get my money back. That kind of tells you this may not be a winner just because my payback is really close to the terminal date of the project. It's like, that's not good. If payback was more like 2 years, there's a good chance that the other numbers would have been positive and better, that we would have taken on the project. Okay, so if this were a replacement rather than a new project, would the analysis change? So remember that they gave us an example of, this is something brand new we've never done before. We're launching a new product line. We have an empty building. We're going to fill it up with equipment and sell a product. And so the change was all the cash flows was changed, right? All of it. But what if it was the scenario of we have an existing product that we're making, and the machinery is getting older, it needs replacement, and also it's possible that the factory would have discovered that there's new technology, new machinery would result in more efficiencies, maybe less labor cost, maybe less raw material waste, whatever it would be, and they've discovered that it does make sense then to go through the process of buying new machinery. Okay, so that's more of a replacement then. And obviously you would sell the old equipment, you dispose of it or trade it in or whatever. If it has value, you get rid of it and get the cash for that. You then buy the new machinery, and the incremental basically is what's the cash flow from the new machinery versus what was the cash flow from the old machinery. So it's that difference now. So now it's more of a change, which means incremental. Okay, so the relevant depreciation expense would be the change with the new equipment. Obviously, we get our depreciation boost from buying new equipment and then depreciating it. Okay, so that's part of that analysis too. So that one's a little bit more challenging to do. That's why they gave us the example of something that was just a brand new project to work through. There's three kinds of risks. So all projects have risk, and the key is how to manage that risk. Well, first of all, understand what the risks are, and then manage those risks. Because anytime you've got cash flows that you're projecting over a series of years, there's risk, right? The longer the project, the more risk there is, right? The more uncertainty there is for the farthest years of my projection. So you saw the three types of risks, and the first one's standalone risk. Basically, what is the risk on the project if it were operated independently? Keep in mind, most companies have a portfolio of projects that are always happening. Okay, there's always a number of initiatives that a company is working on that affect cash flows and risk. So what they're saying for this one is, what is the project's risk if it was just all by itself and you did not take into account all the other projects? Okay, so it's measured by standard deviation, what they call the coefficient of variation, and it ignores the firm's diversification among projects and the investor's diversification among firms. So you're just looking at the risk of that project kind of in a silo without taking into account how risky is the business and industry and what's the risk of the other projects we've undertaken. Okay, so the standalone risk is just the risk of that project all by itself. Corporate risk now takes into account a little bit more, a lot more actually. So this takes into account the diversification of projects within the company. Does this company generally tend to invest in riskier projects or safer projects, or maybe a well-balanced portfolio of safer, risky, and a lot more in the middle? It's really up to the company, right? It's up to company's management, their risk tolerance, their market position, their cash position, and so on. And obviously some industries just require that you take on more risk than others. In technology, being a first mover is a big deal. You might be willing to take on more risk to get new projects and initiatives launched to market before your competition does, because being a first mover helps you gain market share. Other industries would no, we're not doing that. Everybody's kind of more slow and takes it steady and does more stable and less risky projects. Okay, so just kind of keep that one in mind. Then the last one is market risk. What's the project's risk to a well-diversified investor? Basically measured by the project's beta, and it's considered both corporate and stockholder diversification. So kind of think of the stuff we talked about back in chapter 9, and that was the equity chapter. We talked about stocks, and we kind of talked about beta back then, where beta was a measurement of risk. And so beta is calculated using standard deviation and coefficient of variation. So just keep in mind that you can actually calculate something like beta on a project. Okay, so you can do that. What is the risk, or what's the likelihood of this project accomplishing the cash flows we project for it? And so you can do those types of calculations. And then market risk is, again, it's just like thinking if you're an investor and you have a diversified portfolio of stocks that you own, which most investors do. It's no different. So how does this project fit into having a diversified portfolio of projects? That's the market risk. Okay. So it says on the next slide which risk is the most relevant. Market risk is the most relevant for capital projects because the goal of management is to maximize shareholder value, to make the company worth more. Okay. However, corporate risk affects creditors, customers, suppliers, and employees, so it should not be completely ignored. So the authors of this book believe market risk is number one, but don't forget about corporate risk is basically their answer to that question. Now, standalone risk, though, is the easiest one to measure. So the one they say is least important, obviously, would be the most easy one to calculate, right? But that's what they tell us, so just kind of be aware of that, too. And then they ask us, are they correlated? Yes. The risk of all three of these move in the same direction, good or bad. Okay, so then we get to sensitivity analysis. That's what I call playing the what if game, So we can look at a cash flow projection like the one we just got done doing. We're going to sell 100,000 units of a product for $2, make $200,000 a year, and so on. And obviously that had assumptions built into it. We were assuming that we can sell 100,000 units. We're assuming we can sell them for $2 each. We're assuming that the cost of goods sold to be 60%, right? There was three assumptions right there. And we assumed that the sales volume would be the same every year. We assumed the price would never change. So we know that that calculation did not work. It came back with a negative NPV, an IRR and MIRR both below the WACC, so it didn't work. So what we should be asking ourselves is, what would make it work? Was there something in my assumptions that I'm missing? Can we do something different? If I change the price, would I sell more? Is there something I can do to gain some cost efficiencies and reduce my variable cost of goods sold from 60% down to 50%, right? Now, keep in mind, anybody can change a number on a spreadsheet, right? We can always do that. There's no challenge in doing that. The challenge is, if we change our assumptions on a spreadsheet about cash flows, is it really achievable? So that's the question to kind of remember is, okay, maybe we realize our pricing is low. In reality, we can sell these things for $250. Well, is that real? Do we have market data? Do we have market information that says this product will be sold for $250? Because if that's not true, our project won't work, right? So I need to have a reasonable enough confidence in what I can charge for that, or else I'm going to have some problems. Okay, so kind of just keep that in mind. That's a big deal. So advantages and disadvantages of sensitivity analysis. We're trying to find what variables have the biggest impact on profitability, and basically the cash flows that will make a project work. Is it pricing? Is it volume? Is it cost? Whatever that is, we don't really know, but those would be kind of the three big inputs for the particular project we looked at. Now, disadvantages does not reflect diversification and does not incorporate any information about potential forecast errors. So that's one thing to keep in mind also. And then what they're saying is they talk about inflation here, but let's pretend it's not inflation and say, what if we can raise our prices by 5%? Okay, let's just say that every year we plan to raise our prices by 5%, and we'll still keep our operating cost at 60%, but we just kind of said operating costs are 60% of revenues. Okay, so as revenues go up, then so would operating costs. So the question would be, let's just think of it like this. If I raise my prices by 5% starting in year one, would this project work? Okay, and I can just do the calculation to see if that would work, and if the cash flows say yes, this project now is viable. But then I have to ask the question, well, can I really do that in the marketplace? Would the marketplace let me sell the product for more than $2, right? So at 5% higher, it'd be $2.10 in year one, and so on. So here's my new cash flows based on starting in year one, increasing at 5%, and then remember that everything else kind of goes up in correlation because operating costs are 6% of revenues, and then tax is 25% of my EBIT. So all my cash flows go up now, Don't know if they went up enough though to make the project viable or not. Well, the answer is yes. Okay, so remember the WACC is 10%. This comes back as a positive NPV of $10,400. MIRR is 11.2 above 10. IRR is 11.9 above 10. Payback's 3.3. That's fine. So if that worked, if I could increase my prices by 5%, the project works. Now, we also have to ask ourselves, how real is this, right? How close is this? Because to me, this is on the bubble, right? 11%, 11.9, 11.2 is not that much higher than 10%. So there's not a lot of wiggle room if this doesn't work. And is it worth taking on the risk of this project to get a $10,000 NPV, right? That's the question management has to ask. We have to kind of come to the conclusion, how certain are we about these numbers? Are we certain our market research has been done really well? Do we feel like this will work? We've got to kind of go through that process, because if it was me looking at this project, I would say, I need more bang for my buck than $10,000 NPV or 11% return on a 10% investment. I want something bigger than that. Yes, this project will add value, but is it enough value in relation to the risk we're taking to get that value, right? Only management can truly answer that question. Okay, so here then is the one way to take a look at that. So we could do what we call a scenario analysis. Remember, we are assuming we can sell 100,000 units. So we can go through that market analysis and assign a probability to different scenarios. So we can say, worst case scenario is we only sell 75. The base case is we sell 100, and the best case is we sell 125. So with those three right there, I can apply a probability to each, and each probability will then help me figure out kind of what is the risk of the project. So by doing this analysis, it helps me figure out what are the odds of this working. So basically look at it like this. There's a 25% chance I'm going to lose $43,000. There's a 75% chance that I'll make at least $10,000. If I look at the two, the 75% chance that this project works. 25% chance it doesn't work, 75% chance that it does work. Okay. So again, having this information means I can make the best decision. And again, I got to go through that process and go, if this doesn't work, I'm going to lose a lot of money. If it really works, I'm going to make a lot of money, right? And how certain am I about these probabilities? Okay, so we can estimate NPV then based on the factors. And so we get down to the 10.4 base case scenario. And then we can compute what they call the standard deviation of the NPV, and that's 37.8. And then the coefficient variable of this is 3.6. Okay. And the higher that number is, the more risk there is. Okay, so that'd be a high-risk project. Remember that when you look at a stock, 1 is the beta of the market. So anything above 1 is riskier in the project. It says for us, this particular company, most NPVs have a coefficient varying of 1.25 to 1.75. This project is more than double that, right? So because it's such a high-risk project, management would have to decide, is this worth doing, right? So that's part of the analysis management will have to go through. Okay, that's kind of what they're telling us right there. If the project had a high correlation with the economy, how would the corporate market risk be affected? So this kind of tells us what's the risk of the company with this project versus the risk of the company, its beta. Now, obviously, if we take on riskier projects, that increases the risk of the company, right? The company's beta would go up with the more riskier projects that we took on. So kind of helping us kind of understand a few of those points right here. So if it says here we've got a kind of a plus or minus 4% risk adjustment for the cost of capital, would we accept the project? So that would mean that we'd have to get to a 14% cost of capital. If we used a 14%, the project has a negative amount. If we use a lower one, 6%, then the project obviously has a very high NPV. So we got to look at both factors, both sides of that, and what the certainty is of coming back with those. So what subjective risk factors should be considered before a decision is made, right? So we focus on the quantifiable first, but there's subjective things we have to worry about also. Obviously, a numerical analysis sometimes fails to capture all sources of risk. We have to be aware of other sources of risk that were not captured in the analysis. So if the project we sell might result in lawsuits, product liability, refunds because it breaks or it doesn't work well, those are all things to be concerned about. Something that would make the project less risky is if we're just not selling enough product after a couple of years, could we redeploy this equipment to make something else? If the answer is yes, and that would be easy to do, there's less risk. If whatever we're making doesn't work out, we'll just make something else. If that's a factor, that would actually reduce risk of the project. And so it leads us to real options. Options are basically choices that management has, actions that you can take to improve cash flows after the project has been launched. Okay, so obviously you launch a project, you monitor the project, you're looking at your initial projections. As you get real-time actual numbers, you're comparing them, and you're kind of trying to make that decision and that analysis of, is this working, yes or no? Obviously, if it's working, we're good. We can think about, let's make it work better. If it's not working, we want to have with us options that we can take, actions we can take to improve the projections, to make the numbers better. So the more options we have, the better choices we have, and the more likely the project will cash flow. Okay, so a couple of options: abandonment, just cut our losses and move on. The timing of when we do the expansion, when we go ahead and launch the product line, timing matters quite often. Could we do an expansion? Could we repurpose the machinery and make something else? Could we add a new input and adjust the product to make something else? Trying to meet maybe changing market demands, or we try to reduce the cost so that we can sell more. Whatever that would be, the more options we have, the better off we are. So they're kind of showing us here. We're moving on to a new project. If project Y has an initial upfront cost of $200,000, we expect to produce cash flows of $80,000 for 3 years. At 10%, what is the project's NPV? And you can see it's just a little bit of a money loser. We're going to lose about $1,000 on it. So obviously, we would not take on the project knowing that. And it says here the cash flow is critically dependent upon a customer accepting the project. And there's a 60% probability the product will be wildly successful and produce cash flows of $150, and a 40% chance that it will be actually not work out and have a negative cash flow of $25,000. And so we can kind of go through the process and say, what would NPV be based on that? So in the best case scenario, NPV is 173. In the worst case scenario, it is -20. And as we combine the two, we get to the base case assumption of just over $1,000 NPV. Okay, so assumptions that go into that: the company does not have the option to delay the project. The company may abandon the project after a year. The company has not adopted the product. If the product is abandoned, there will be no operating cost incurred or cash inflows received after the first year. So then we can kind of look at that and go, okay, what are our options? So option 1, the 60% is it's wildly successful, it works. Okay, we get 173. If the customer does not accept it, we cut the cord after year 1. We lose $25,000 in year 1. And we do the new analysis, and we get a 40% chance of losing $222,000, a 60% chance of making 173, and the net effect is $14,725. Okay, so would abandonment affect would the abandonment option affect the WACC? Yes. Okay. The more options I have, the more choices I have, and actually it reduces the WACC, right? So I might be more likely to take on the project in this scenario where I can abandon it and cut the cord and move on after year one. Okay, so that's actually a better option than the previous example where we had to suffer through 3 years of losses. So I only have the 1 year of loss, and so I might be more likely to take on the project. So that's what they mean by abandonment. Okay, so that was chapter 12. If you have any questions, as always, just let me know.